On today's educational short, we're going to be talking about the cash flow analysis. Let's dive in. So the cash flow analysis is an extremely important piece of the puzzle when considering is a practice a good fit for you and fit your lifestyle and needs to pay your bills, as well as going into the practice evaluation side of things. How much is a practice worth? Obviously a practice that cash flows more than another, generally speaking, is going to be worth more than one that doesn't cash flow as well. So those are the basics. We're not going to be talking about practice evaluations today. We're going to focus solely on the cash flow analysis and what you need to be looking at and what are some of the pitfalls in the cash flow analysis that we oftentimes see. So when you look at a lot of these cash flow analysis that are usually put together by a CPA or a practice broker, you need to understand that all these analyses are put together as if they're determining income before taxes, depreciation, amortization, and interest. A lot of times people think, oh, EBITDA. Greg, I've heard that acronym before. It's EBITDA. It's not technically EBITDA, because EBITDA is how much money would the business make being 100% associate driven. What we're trying to determine in a cash flow analysis, generally speaking, for an owner user who's buying the practice for themselves, which is most of the opportunities out there that you're looking at, and if you're listening to this video, it probably applies to you, is you're trying to figure out what is the seller's discretionary earnings, or what we'd like to call, in short, net earnings. So one of the first things that we oftentimes hear from a first-time buyer is, Greg and team at Doctor's Choice, I'm looking at this tax return or financial statement. This practice loses money, but it's doing $800,000 a year in collections. Let's start off and just clear the air here that business financial statements, in some regard, mean absolutely nothing, right? It is the sole job of the business owner and their accountant or CPA to basically show as little profit as possible to pay less money in taxes. So we have to keep that in mind when we look at these things, because a lot of business owners are running personal expenses to the business. So when we do these cash flow analysis, the main goal is to extract all of the personal expenses that the seller runs through the business, as well as what we like to call one-time non-recurring expenses. An example of a one-time non-recurring expense is going to be something like the seller had to replace an AC unit, right? That's not something that hopefully happens every year. That's something that's going to happen only every 10 to 20 years. What if they replaced, the dental compressor? There's another example. So those are what we call one-time non-recurring expenses. So we typically remove those out of the equation as well. And we're trying to determine what is the cash flow for a buyer if they were to buy this business, replicate the same income and collections, and have the same expenses. How much money would they make after we take all those things out of the equation? So oftentimes when we look at other people who do these cash flow analysis, you'll see probably some notations in the cash flow analysis that we're making a normalization. From a buyer's eyes, it is extremely important to ask for documentation and have a complete understanding anytime there is an adjustment to an expense as reflected on the financial statement. There are some ones that are easygoing that you probably don't need reasonings for or documentation on. For example, auto expenses. You don't need documentation on that. You know that's a personal expense. But what if someone says to you that, hey, 50% of my office expense, which is $40,000 for the year, so $20,000 of that $40,000 are personal Amazon expenses. I buy stuff for my personal self, for my household through there. You should not just be taking their word for it. That's $20,000 of net earnings or net income, and that is going to significantly play a role in the practice evaluation one and what your actual take home should be if you buy the business. So you have to ask questions and ask for documentation on some of these things. I will oftentimes see people normalize expenses for dental lab or dental supplies, saying, oh, the seller's operating at 12% dental lab cost, we'll just normalize that to 9%. No, you can't do that. So there has to be a rhyme and reason to it. So don't let someone, when looking at some of these cash flow analysis, just start normalizing anything just because of what you should be operating at. No, this is what the business operates at. There's probably a reason for it, so it needs to stay as is. So in closing, we want to make sure we're on the lookout for unjustified normalizations or add backs or adjustments. We want to make sure that we're asking for detailed information and documentation as to why something was added back or adjusted. And overall, just making sure it makes sense. There's a story behind it on top of everything. So if you're looking for more tips and tricks about practice transitions, follow us, and we're putting out more of these educational shorts. Cheers.